Welcome to this brief introduction to the Audit and Assurance paper. You may sometimes see this paper still referred to as F8. The names have been changed slightly, but there's been no change in the syllabus content, depending whether it was called F8 or whether it's going to be called Audit and Assurance. Let's see, first of all, what's on the syllabus, and to some extent the syllabus almost follows the pattern of how an audit takes place. Section A, slightly out of that series of steps, Audit Framework and Regulation. What power do auditors have? What is the purpose of an audit? Why were they brought in? How are auditors regulated? How do we know when they're doing a good job? But within that, very, very importantly, there's the idea of ethics. Auditors are basically signing off sets of financial statements, often saying that these financial statements show what's called a true and fair view. In other words, that members of the company, the shareholders, can place some reliance on these financial statements. But if you are going to place reliance on these financial statements, and indeed reliance on what the auditors say about the financial statements, there must be a belief amongst shareholders that what the auditors say is worth actually believing in. That the auditors will not say that the company is doing well for some reason. Maybe they want to keep the audit, maybe they want to please the directors, but actually the company is not doing well. Ethics, if you like, is almost auditors' unique selling proposition. If an auditor is not ethical, then really the auditor's a waste of time, because you've got people who are reporting on the performance of a company who will almost say what they're paid to say, rather than stating what they see to be the truth. Within this framework and regulation, it even starts by saying, do we want to be the auditors of a certain company? It could be that we have got a family relationship. I'm the partner of the audit firm, but my brother is a finance director. And obviously that close family or even friendship relationship could mean that my judgment is going to be skewed in some way. I can't be properly objective. It may be that we feel that the directors of that company can't be really believed, that they are likely to deliberately mislead us, and we might find it better to have nothing to do with the people there, rather than to risk our reputation, to risk lawsuits and so on. So before you even get into being an auditor, you have to think, do I want to be the auditor? Is it wise for me to be the auditor? Am I actually capable of being the auditor of this company? Once you're in, then the first step was going to be a planning and risk assessment. So risk assessment is really thinking, where can things go wrong? Where are the financial statements? Which elements on the financial statements are likely to be the most vulnerable? So if you're dealing with a firm of jewelers, then of course inventory is going to be very vulnerable. It's small, it's high value, it's easily stolen, it's easily mixed up. And how do we know that the closing inventory is actually what it is proposed to be? What they actually put in the financial statements. In other businesses, if you weren't dealing with a kind of cash business, if you're sending invoices out to people and hoping to be paid, then it could be, of course, that the area of risk is whether or not those amounts are ever going to be received. There is a kind of bad debt risk. So what we're doing is we're saying, where are the big figures? What is vulnerable? What could go wrong? And then what you have to do is respond to that risk. So if something is a big risk, then by and large you're going to do far more audit work there to satisfy yourself that the financial statements are to a reasonable degree of assurance free of material misstatement. So audit is very much risk-based. More work where the greatest risk is. Less risk means less work. Internal control. Well-organized companies should have a good system of internal control. For example, it shouldn't be up to just anyone to send out a purchase order. It shouldn't be up to anyone just to say, right, we'll send you goods and we'll then invoice you for $250,000 when you've never heard of that company before. Only a madman would kind of do that without, for example, taking up some sort of credit references on this new customer. Or no one's going to really allow employees to self-certify their overtime. So systems of internal control really means that if there's a good system of internal control, basically it can be one person checking on the work of another person. It can be authorizing stuff. It can be locking stuff away to keep it safe. You'll see a variety of ways in which control over the assets and the transactions can be imposed. If there's a good system of internal control, the chance of something going wrong in the first place, an error or a fraud indeed, is very much cut down. There is less risk, and well-organized companies with good internal control, it means the auditors have to do, in general, less work. If the company is chaotic and the internal control systems don't function or don't exist, then the auditors have to do an awful lot of work to satisfy themselves that the financial statements are showing a true and fair view. And some of the questions you'll get on this is to evaluate a system, an accounting system, see where there are perhaps what are called weaknesses in internal control, like employees certifying their own overtime, and no good control on putting through salary amendments, for example, and then suggesting how that could maybe be rectified. And also evidence, before we get on to D, but internal control requires evidence. If you're told that overtime is always signed off by a supervisor or a manager, then you have to gather evidence that it is indeed signed off, that it is a control which is actually operating in practice, rather than one which is simply there in theory. Audit evidence about internal control, but also audit evidence about the figures in the financial statements. How do we know that the inventory is okay, that the receivables are okay, that the cash is okay, that the payables are okay, that the non-current assets are okay? I'm using okay in a very kind of colloquial sense here. But basically everything that appears in the statement of financial position needs some evidence. And you'll come across something which is called the assertions. So a figure to do with inventory is saying that the inventory, it exists, it is owned by the company, that it is a proper valuation and the like, that its condition is okay, it doesn't have to be written down to the lower of cost and net realizable value and so on. So for each of these so-called assertions, you need evidence. If you wanted to change the word auditing to another kind of phrase, you'd say collecting evidence. Auditors are collecting evidence about what's in the financial statements, statement of financial position, cash flow, the notes to the financial statement, the statement of profit and loss and so on. Everything appearing in the financial statements requires the auditors to get evidence to back it up. And then finally, review and reporting, in particular the audit report. The audit report is almost what the members of the company are paying for. It is going to appear in the financial statements. And if everything goes well, the auditors will be able to say that the financial statements, to a reasonable assurance level, are materially free or free from material misstatement. In other words, you can rely pretty well on these financial statements. If the auditors discover something wrong with the financial statements that's material, or they can't find information about a material figure in the financial statements, then they will have to what's known as modify their opinion. They will say that the financial statements show a true and fair view, except that we couldn't find very much evidence about inventory, or except that we don't think that the debts are all going to be received, and we thought an allowance against bad and doubtful debts should have been set up. So that's very much the end position. Nowadays, the audit report is really quite long. It's about a page of A4 paper. There's all sorts of absolutely required paragraphs within that. It's not something they can auditors just make up. It is very closely laid out in auditing standards how the contents of the audit report are going to be set up and displayed. What is the exam format? Section A, you've got what's called case questions. These are essentially multiple choice or objective test type questions. What's meant by a case question is you've got one piece of information, and basically then you've got 5 questions kind of emanating from that one little mini scenario, a couple of sentences. Sometimes a question, each of the 5 questions add just a little bit more information, but all of the 5 questions are kind of cluttered around the one kind of little mini case. They're all independent. If you get part 1 wrong, shouldn't jeopardize your chances in getting parts 2, 3, 4, and 5 correct. But basically these are objective test questions. Section B, these are longer, what I would call written questions. There's a 30-mark question, and then there are 2 20-mark questions, bringing up the total there to 100 marks. In the written format of the exam, you get 1 hour, 3 hours, 15 minutes. In the electronic form of the exam, the online exam, you get 1 hour, 20 minutes. And within that, and it's allowed in the time, there are, I think it's 10 additional questions, which, and you won't necessarily know which questions they are. There are 10 questions that the ACCA is kind of trying out, if you like. The ACCA is very careful in designing objective test questions. It doesn't let them be used for real, if you like, before it collects all sorts of statistical information to prove that the question is fair and that it is operating properly and so on. So what they do is they seed into the exams some additional questions where they can gather statistical information on these questions. They will not count towards your exam, but they are going to be very useful for people who are following you to make sure that their exams are also fair. Section B, in other words, the long written type questions here, is predominantly planning and risk assessment and internal control and audit evidence. Okay, it's not particularly going to be looking at regulation and so on here. It's, if you like, the main bit of the audit here. Planning, risk assessment, assessing internal control, giving advice on internal control, and collecting audit evidence. That's the heart of the paper.